Morning all. It's not good. It's raining here, although that doesn't mean it's not good. It just means I'm going to get wet when I walk out of my man cave. There we go. No, gold, interesting. Gold is very sensitive to lots of things, but it is actually dominated. Gold's very sensitive to interest rate decisions in the States because it affects what happens to the dollar. Being a dollar-based commodity, that also affects, obviously, gold. So Stuart's right. Last week, especially the sort of move in the dollar on Friday, that had a dramatic effect on gold, as you can see here. Not the biggest candle ever. I should say ever. Probably it's close. I think if you go back to the 4th of December 2023, we had a candle of $125 or more. So that's what, 1,250 pips. Horrendous. Evening to you, Tina. Well, I hope you're having a nice evening. Even though it's your winter, Tina, I suspect your weather's better than mine. It's a pastime of mine complaining about the weather, but it's 14 degrees here in June. Honestly, my mother used to describe June as flaming June. It's more freezing June, I'm afraid. Freezing June. Anyway, yeah, good to have you all with us. It's another important week this week for global markets. We've got inflation data coming out of in the States ahead of the FOMC. So that's the Federal Open Market Committee. That's the committee that decides on interest rates in the United States. If you just remember, if we look at, oh, I haven't got it up here. Let's just open it up. Put it there. If you remember, the FOMC, that's the rate setting committee for the Federal Reserve. The Federal Reserve is the US central bank, and they meet. We keep on saying their monthly policy meeting, but there are 8 meetings per year. Clearly, that means they're not every month, but you can see when the dates are when you look at this CME group. It's called their FedWatch tool. The next meeting you can see here when my cursor is the 12th of June, and there's a 99.4% chance that rates will stay the same. So you know pretty much what's going to happen on Wednesday. But that's so it's an important week, and you might think, well, Jerry, if we know that they're not going to cut rates, well, why the interest in it then? Well, actually, they do publish a statement. They do have a press conference, and we like to know what's going to happen in the future. That's the key thing for us as traders. Is it going to and investors? Are we expecting interest rate cuts in the future? What do the committee think about that? And as you can see here, if I click on September, you'll note that interest rate expectations get there in the end. So there's still, it's unfortunately, the probability of a rate cut in September has subsided a little bit. Now there's only a 48% chance of a rate cut in September. And by year end, the last meeting on the 18th of December, there's only a 45% probability of a second cut to 4 3/4. So it's nothing like as bullish as it was at the beginning of the year. We had 7 rate cuts priced in, albeit obviously way ahead of time. And obviously these probabilities are fluid. They change. They've literally changed by 0.5% from first thing this morning. So it happens all the time. Anyway, let's have a look, because we've also had these we've had these European parliamentary elections, and it's all over the news. Far right making significant gains in these European parliamentary elections. That's in France, the RN party, and Macron struggling with his own alliance, getting half the vote, apparently. This is according to exit polls. Then another article referring to Emmanuel Macron, who's gambled on a snap election in France to try and wrest back some sort of initiative from Marine Le Pen, who heads up the nationalist RN party. So it's all over the press, BBC, Reuters. It's all big news this morning. Are we going election crazy? We are, Paul. This is the year for democracy. Something like 45% of the world's population are voting in elections. Not all of them are proper democracies. Russia, not a great democracy. Iran, not a stalwart for the obvious democratic sort of setup. But Belgian PM resigned, Macron calls election week before us. The whole political picture could look very. Paul, I agree, and that's reflected in the euro. Look at the euro. You don't often see the euro gapping down. Look at that. After that big fall Friday, prompted by the very strong, well, strongish non-farm payroll, and there were some nerves ahead of the European Parliamentary election, which on a Friday afternoon, there weren't many buyers of euros at the time, and that really was like a knife through butter. And it gapped down Sunday night, Monday morning. So here we are, 107.65, and we've been as low as sort of 107.46. As Owen says, the political news in both the US and EU. And obviously, the implication is Marine Le Pen, her political party, and again, I think within the European Parliament, it's referred to as the European People's Party. Within France, it's Marine Le Pen's RN party, and they've got significant momentum. And it's likely, that this big gamble for Macron, he's hoping to wrest back some of the initiative from Marine Le Pen, but it'll either halt her progress or it will result in RN becoming the dominant force in France, and will certainly change the direction of the EU, and that's reflected in a weaker euro. You need to buy your holiday euros. Yeah, well, yes, it's yeah. You're going to get more for your euros when you look at euro sterling. Who said that? Paul. Yeah, when you look at euro sterling, yeah, look at that. Euro really weak against sterling there. Gosh, you've got to go back a long way to see it down here. Gosh, that really is a multi-month low. Yeah, you got to go back to September 22. Buy those euros. Yeah, you get a lot better rate. Keeps the cost of those inflated holidays a little bit lower. Probably, maybe a little bit too late. I don't know. No, it's good for you. Buying euros, you get more euros for your sterling. Anyway, let's have a quick run through, everyone. So mixed messages last week from some data. Just to remind ourselves, we had something called the ISM manufacturing PMI, worse than expected. Remember, an economy is made up of manufacturing and services sector. There are two sectors. Most developed economies have a lot higher, a bigger service sector compared to the manufacturing. Manufacturing tends to be done in developing countries, China especially, not necessarily developing anymore, it's probably more developed now. And you can see here the services PMI data in the US a lot stronger than expected. Our service sector here in the UK is 80% of our economy. Only 20% manufacturing. Says it all, doesn't it? But 53.8, way stronger than expected. And I think, the ISM manufacturing data was weaker than expected, whilst those ISM services data came in much stronger than expected, as I say, at 53.8 versus that consensus of 51. And US equities, well, they responded immediately with the S&P and the NASDAQ hitting all-time highs again. Yes, all-time highs. Quick look at the S&P 500. There you go. There's the candle on Wednesday. And I just was looking at this and I just thought, gosh, no interest rate cuts yet. Possibly an employment market that's slowing down slightly. But when you look at some of these numbers coming out, that ISM services data, it's a pretty strong. You can't have a strong economy and have interest rate cuts. Interest rate cuts are because inflation's coming down and the economy is slowing. No, inflation might be coming down, but it's not really coming down enough for the Federal Reserve. But the economy is definitely not slowing as much as some participants were hoping that would result in these interest rates cuts. You can't have your cake and eat it. You can't have a strong economy and low interest rates. Doesn't work. Anyway, non-farm employment change, remember that? The data at the end of the last week, an important data for the markets because it informs the Federal Reserve, and the Federal Reserve have also not just got to maintain price stability, that means keeping inflation in check, but also maintaining full employment. There's no such thing as full employment. We're pretty close to it at sort of 3.5%. Unemployment is expected to tick up a little bit. Was expected to sort of remain unchanged, but ticked up a little bit, I should say, to 4%. But actually, the way this number was interpreted, the headline employment report looked strong, but there were signs that the data continues to imply cooling in the labour market. And you might think, really? But sure, you've got a higher than consensus unemployment rate at 4%, wherever that is, highlighted there, and a slowdown in wage growth. That's not shown here, but when you look at the detail of the report, there is a slowdown in wage growth in the service sector. That's going to help the Fed when it comes to sort of deliberating rate cuts in the future. Sadly, not this week. But interest rate expectations drifted lower last week with the probability of a rate cut. We were just looking at it, weren't we? So the probability of a rate cut in September now standing at 47% versus 60% a week ago. And then a second rate cut by the end of the year in December fell from 54% a week ago to 45%. Well, you're going to say, well, what does this all mean? Well, it basically means if interest rates aren't going to come down in the US, it underpins the US dollar. Yeah. And that's why the US dollar, boom, did this, why it firmed up. That's the reason. And also, when the dollar firms up, it undermines dollar-based commodities, gold. There we go. So you've at least got a clearer picture of why that is happening. And yes, this FedWatch tool, these interest rate expectations are fluid. Then they literally any 1 minute per day, they change. They will reflect current thinking on forward rates. And until the rates are changed or these meetings passed, the probability can shift. And of course it can shift before Thursday, when we've got the FOMC. It's on Wednesday evening, I do apologize. So on Wednesday evening, we got the FOMC meeting again. But before then, we've got unemployment data. Unemployment data, I'm going absolutely barking mad. We've got CPI, inflation data, that's what I meant to say. And inflation, prices, that's the one of the Fed's mandate is to maintain price stability. So this could have a big bearing on what the Fed agree. I somehow doubt it. I think they've already made up their minds, really, and it's a question of what they tell us about future rate cuts is what's going to interest me and the markets. Okay, on to these parliamentary elections in Europe, because this is something we can't ignore. I know it's already happened, and we're not talking about the calendar this week. We've already had these parliamentary elections. They took place across the EU with exit polls, and I don't believe we've had any of the clear results yet, but the exit polls have put the centre-right Europeans People Party on course to win 189 seats. That compares with the Socialists and Democrats on 135 seats. And I think more damning for the exit poll in France, which forecasts the RN party, and that's led by Marine Le Pen, on 31.5%, while President Macron's, he's got this alliance between his new party and others, that was forecast to receive just 14.5%. Anyway, yes, it means all change. There's another election now. they're having their election. Well, they're sort of having their election before us, actually. I think, Paul, you were referring to it. I think the actual election is scheduled for the 30th of June. Yes, I know that's before the 4th of July, our election, but they then have a runoff on July the 7th, which is after ours. So we'll beat the French. We'll beat the French with our results. Anyway, it creates instability, uncertainty. That now is reflected in the euro. Why? Well, it's possible with what's happening in France. Remember, France is the second largest economy in the EU and the Eurozone, and it could well result in RN, that's Marine Le Pen's party, should she prevail in this election, she could be the dominant force, which in almost certainly will result in a change in direction for the EU and the Eurozone. Anyway, there we go. I feel like I'm grandstanding. I feel like I'm on a soapbox here, but I find it fascinating what's happened. I really do. I think it's the biggest gamble I've ever seen, and it's almost like Macron's decided he's been boxed in, and to a certain extent, he is. You know, he said, I've got a quote here for me, who always considers that a united, strong, independent Europe is good for France. This is a situation which I cannot countenance. What he means is, he's said he's decided to give you back the choice of our parliamentary future with a vote. But there have been rumours for some time that Macron might call an early election because he's struggling in Parliament, or Parliament is struggling to function effectively because there's a sort of just deadlock. But it's a big gamble, and I've got a feeling it won't pay off. In fact, I'm pretty certain it won't pay off. But who am I? Who am I to say? Anyway, quick look at the US dollar. We've looked at equities. We know what happened with those. A significant move in the US with record highs in the NASDAQ and the S&P. Europe not doing so brilliantly. UK down 1%. The DAX down 0.25%. This morning, the CAC completely fallen out of bed. The CAC Oran, CAC 40. I don't think I have it on here. If I did, it would show you it's down about 2.5%. So that's what the markets think of the uncertainty about that's been created by the call of an election by President Macron. So currencies, well, we know what's going on. The dollar reacted very positively last week to the better than expected US non-farm employment report. I said those weekend nerves ahead of weekend nerves, not weekend, but weekend nerves ahead of the European parliamentary elections also resulted in a bit of a weak euro, and it was really weak against all majors, really. And I think, because we're all sort of fretting over the potential impact of a shift in the political landscape in the EU, and guess what? Exit polls have confirmed just that. Big surge in support for the far-right parties, not just in France, actually, in Germany as well. The AfD has been forecast to do really well, and it's quite a shift. A shift in the sort of political landscape, and a shift possibly or highly likely in the direction of both the EU and the Eurozone. Of course, FOMC meeting this week will also have an impact on the dollar, and what's going to with the FOMC meeting this week, the reverberations happen and last for 3-4 weeks sometimes, because we obviously expect no change in interest rates, but the statement, what they say in the statement, is what the markets want to read. We need to know about clues about shifts in policy between now and the end of the year. So this is a really critical week for interest rates that affects people's borrowings, mortgages, corporate debt, sovereign debt. It affects currencies that affect commodities. It's all encompassing. So this is such an important week. Every month that we have an interest rate decision is absolutely key. Not just in the US, here in the UK, in the Eurozone. We had a 1/4 point cut in rates last week in the Eurozone. That didn't undermine the euro initially, but actually it's other factors now that are undermining what's going on. The fact that there is this uncertainty, the fact that the ECB said that they'd adapt their policy depending on what the data says. Of course, that's what every central bank says. But now things have moved on, and we've got this European Parliamentary Elections that really is throwing a big question mark over a lot of things. Commodities, well, we've talked about gold until we're blue in the face. Oil, yeah, a bit of a bumpy move there. Oil reacted negatively to the delayed OPEC Plus meeting from the previous Sunday, so a week and a day ago. I think OPEC Plus has sort of boxed itself into a corner with demand forecasts sort of implying a mixed picture, whilst supply continues to build, with the non-OPEC oil producers making up a lot of the 2.2 million barrel per day reduction by OPEC Plus members. Anyway, OPEC Plus agreed to extend their voluntary cuts, as we discussed this time last week, into Q4, but they also agreed to some members increasing productions in Q3, effectively unwinding some of the voluntary cuts. And I think the problem for OPEC Plus is that it's losing market share while supporting prices. Well, not that effectively, as you can see. They were targeting $100, and really ever since sort of mid-April, market has fallen from $90 down to below 80. So by losing market share to try and support prices, not very well, they've also benefited non-OPEC members. But of course, any unwinding of OPEC's commitment to restrict supply will undermine prices further, which is the very thing that OPEC Plus wanted to avoid. So they're in a bit of a bind, and hell, it's a cartel. Need I say more? They do things for the benefit of themselves and not for the benefit of us consumers. They'll say they do, but they don't. They don't at all. Okay, data and events. Gosh, 20 past, I'm so sorry, a bit late here. Interest rate decisions, we know all about that, and inflation data. Let's crack on very quickly. So nothing on Monday. Tuesday, we've got unemployment data, so this claimant count here in the UK, and average hourly earnings. Expected to show a slight increase in claims. Sterling will be sensitive to this release at 7 o'clock on Tuesday morning. We then jump to Wednesday. Got CPI and PPI coming out of China. This is inflation and the producer price index. That's the precursor to inflation. China's managed to lift CPI or inflation over the last 2 months. And it sort of quelled any concern about a deflationary spiral in China. But the PPI, that's the sort of forward, it's almost like that sort of tells us a leading indicator to future inflation. It's still negative, although forecast to be less negative, but it suggests there's still little price pressure at the factory gates in China, which won't help inflation going forward. And just by the way, we do need inflation, or generally economies need inflation. If you're manufacturing stuff, you have to have the ability to raise your prices. Michael, we're still under 30 minutes. Gosh, thank you. Was it you? Stuart was late, wasn't he? Yes, Stuart. It's all Stuart's fault, not because I'm a bletherer. GDP data. Okay, this is the monthly gross domestic product reading for the UK. We used to just get quarterly data. This is the monthly one. It's less dependable, as it's subject to revisions, quite a lot of revisions actually, because the monthly data, it's basically getting in the data. What are we now? June. This is for for April. So it's quite a big, data set to collect, and so it is subject to a lot of revisions. But it might help inform us where the UK is at, and I think sterling will be sensitive, but only to a significant swing away from really what the consensus is on the screen here. Then we move to the more interesting part of the week. CPI inflation, that's the inflation data in the States. Headline inflation is expected to rise 1.1%. The lowest, actually, I looked it up. That's the lowest reading since last October. So the year-on-year reading, so there's the monthly data and then the yearly data, that equates to a reading of 3.4%. And the core rate, the one that the Federal Reserve is sort of more interested in, is expected at plus 0.3%, same as the previous month. And that will result in an annualized rate of 3.5%. That's not shown on the screen here, but I can tell you that's what it is. And that's down from the previous month. And this is because of the base effect, where we're looking back at a year and some higher data falls out of that data set, which results in a lower annualized reading. Safe to say, inflation is not coming down as the Federal Reserve would like, but it's not going any higher. So it's sort of, this is not going to help or hinder the Federal Reserve in its thinking. Anyway, later on that day, on Wednesday, we've then got the FOMC minutes. Now, the first thing you'll note is that interest rates are expected to remain unchanged. And we know that because there's a 99% probability according to the FedWatch tool. So remaining at 5.25% to 5.5%, that's the Fed funds rate. Guidance about future rate cuts is really what the market craves. The press conference at 7:30 will be helpful, and obviously the statement will be pored over by everyone, all the participants, and so we'll get a good idea probably before the close as to what it all means. But to say that the US dollar will be very sensitive to this release. US assets and global assets are very sensitive to this announcement. So 7 o'clock Wednesday evening, that's the big one. Make sure you if you are trading DT, please remember, set an alarm call or something just to remind yourself of it. Thursday, we've got the PPI reading. This is the measure of prices for goods and services at the factory gate. So that's going into production. So we're seeing a decline to plus 0.3% monthly reading, and that was following last month's rather surprise jump to plus 0.5%. Nothing too much to say about that, but had PPI continued to remain elevated, it would put a real question mark about inflation falling before the year end, which would then affect interest rate decisions and the probability or the lack of opportunity for the Fed to cut rates. So that's Thursday. Then Friday, I'm just going to jump to the final announcement or the final major event of the week. Actually, I'll talk about the prelim University of Michigan consumer sentiment as well, to be fair. Bank of Japan meeting. This is the central bank in Japan that sets monetary policy. Expect no change in interest rates this meeting. So yes, their interest rates were raised, whenever it was, 2 or 3 months ago, to 0.1% from negative. And you might think, gosh, does it really matter that much? Well, it's symbolic initially, but there is now, according to the forward swaps market, so that's what traders and investors think interest rates are going to be over the next month, is implying a 70% probability of a rate hike in July. So that's something that needs to be factored in if you're trading the Japanese yen. I don't think there's any chance of any intervention, but dollar yen, we're right up there at sort of 157. If it breaks through 160, I suspect, when it went up here, there were rumors about the Bank of Japan checking prices, and it's something that, will affect the Japanese yen. It'll make it more sensitive. What I mean is it's possible that the Bank of Japan could intervene to suppress the weakness in the yen, because it does import a lot of price pressures into Japan with such a weak yen. And it's something like 60% undervalued the yen. Extraordinary. Anyway, the Japanese yen, very sensitive to this announcement. A lot going on this week on the economic front. Yeah, it sort of is, Owen, but I'm making more of a meal of it in a way because there's a lot happened with the European elections and with interest rate decisions, both in the US and in Japan. And it, for me, I'm particularly interested in it. So there you go. You're getting the brunt of it from me because of my own interest. Anyway, that's sort of it, really. Apart from the University of Michigan consumer sentiment, which is a number that I love following, never used to be high impact. I argued that it should be high impact. I don't think they were listening to me necessarily, Forex Factory, but it's a great leading indicator. Consumer sentiment is what drives the economic, the economy, the consumer spending. When consumers are spending, they generate more revenue for companies. Companies generate more revenue. They tend to generate more profits, and that's good all round. So to know what the consumer is thinking and how they're being or behaving is really important, predicting economic the economy in the future. So 73, that's a big jump from the previous reading. And as you can see here, the previous reading was a little bit of a surprise, down at 69.1. We're expecting a jump back up to 73. So yeah, that number will definitely excite the Forex markets especially. So the dollar will be particularly interested in that at 3 o'clock on Friday. Yep, that's it. Thanks very much. Yeah, you have to keep an open mind. Yeah, you do. That's right. Thank you, Owen, for that. I just don't ever get set on anything. My view is to inform you about what the tea leaves are looking like, and they change all the time. You don't have to have a big interest in this at all. I'm here just to let you know. A lot of people just want to understand it so that they have an understanding why these markets go up and down the way they do. But you could just literally exist off price action and following all the rules. That's exactly it. Knowing what I know and what I talk to you about does not help necessarily inform you. It helps remind you to be careful about certain points during the week when, if you're trading intraday, you've got to be very careful about putting positions on ahead of key events. That's what I'm here to do. And also educates you. And with education, knowledge, you become more adept at trading. That's it. 29 minutes past. I did say to myself, don't go past 1:30. There we go. It's 1:30. Listen, have a good rest of the week. I'm sorry to have whittled on, but unfortunately, Michael, I did go on quite a bit longer than I should have done. There we go. Listen, have a good rest of the week. We may in a month's time have a completely different looking French Parliament, and the makeup of the EU will all change. Exciting times. Thanks very much for listening. Catch you again next Monday. All the best for now.